SpaceX just reported the kind of quarter investors normally celebrate. Revenue nearly doubled, Starlink subscribers doubled, and the company's loss was cut almost in half. Then the stock fell nearly 14%. 2 days later, it ripped almost 16% higher. So what exactly is the market fighting over? Because hidden inside these earnings are two very different SpaceX stories, and whichever one wins will determine whether this pullback becomes an opportunity or a warning. Let's begin with what SpaceX actually delivered. Second quarter revenue reached $7.81 billion, up 92% from a year ago, and well above the roughly $6.9 billion analysts expected. The net loss narrowed to $541 million from about $1 billion a year earlier, and every operating segment grew. Connectivity generated $4.29 billion. AI produced $2.56 billion. And the space segment added $962 million. That is not a weak earnings report. The market's problem is what SpaceX had to spend, and what investors are being asked to believe comes next. First, the strongest part of the bull case. Starlink is becoming a very large operating business. Connectivity revenue rose 66%. Starlink reached 12 million subscribers, double the year earlier level. And connectivity operating income increased 79%. That combination matters. Subscriber growth tells us the product is spreading. Revenue growth tells us SpaceX is monetizing the network. Operating income growth tells us the business can create real economics while the constellation expands. And this is no longer only rural home internet. The same network now reaches aircraft, ships, enterprise customers, governments, and mobile partners. Each new use case gives SpaceX another way to monetize satellites it already launches and operates. This is the part of SpaceX investors can already see working. Starlink is not just a promise attached to a rocket. It is the financial engine paying for the next layer of ambition. But this is where the quarter gets much more interesting, because SpaceX is spending as if Starlink is only the beginning, and that creates the single biggest question in the stock right now. SpaceX spent roughly $18.4 billion on capital projects during the quarter. About $15.8 billion went specifically into AI infrastructure. For perspective, that AI investment alone was roughly twice the company's total quarterly revenue. That does not mean SpaceX lost $15.8 billion. Capital expenditure builds assets that may generate revenue for years, but investors still need those assets to earn an acceptable return. The early evidence is promising. AI revenue jumped 247% to $2.56 billion. Compute capacity reached 1.4 gigawatts. And management says recently signed cloud agreements represent $14.1 billion of contracted sales. The tension is timing. SpaceX is paying for the infrastructure now. The revenue arrives later. And management reportedly expects similarly heavy capital spending for the next 2 quarters. That is why the market sold the report. The bear sees a profitable satellite network being used to finance an AI buildout with enormous execution risk. The bull sees SpaceX buying scarce compute capacity while demand is already under contract, and doing it with roughly $100 billion of cash and marketable securities after the IPO. The rocket business is smaller in the quarterly numbers, but it still protects the whole system. Space revenue grew 29% to $962 million. More importantly, Falcon gives SpaceX its own route to orbit, while Starship is supposed to make the next generation of Starlink capacity dramatically cheaper to deploy. Recent Starship testing showed genuine progress, including satellite deployment. The next step is harder: repeatable flights, payload delivery, recovery, and reuse. Until that happens, Starship is upside, not the foundation of the current earnings case. Now, look at what happened in the market. SpaceX fell nearly 14% after the report. Then more than 900 million employee and early investor shares became eligible for trading, potentially increasing the tradable supply by more than 140%. That sounded like the setup for another collapse. Instead, the stock rose 6.1% on the first unlock day. Then, by Friday's close, it surged almost 16% to $133.11, almost back to its $135 IPO price. That rebound does not prove the stock is cheap. It does tell us the feared wave of immediate selling did not overwhelm demand. More lockup releases are coming, and volatility could stay extreme. So, is this a buying opportunity? My answer is cautiously bullish, but only if you treat SpaceX as a high expectation platform, not a normal aerospace stock. The quarter proved that Starlink is scaling. It showed that AI already has real revenue, and it gave SpaceX an enormous balance sheet to build from. But the valuation still assumes that several difficult things work at once. Here are the 3 numbers I would watch next. 1. Connectivity operating income. That tells us whether Starlink remains the cash engine. 2. AI revenue and contracted sales conversion compared with AI capital spending. That tells us whether the build-out is becoming a business. And 3. Repeatable Starship payload missions. That tells us whether the future network can scale at the economics management is promising. If all 3 improve together, this earnings sell-off may eventually look like the moment investors focused on the bill and missed what SpaceX was building. If you enjoyed this breakdown, leave a like and subscribe to Risk On Capital for more company deep dives and investment stories.